Every global system has a pressure point, one actor whose decisions ripple farther, faster, and deeper than anyone expects. In the world of oil, that actor is not the largest consumer, nor the most technologically advanced producer. It is a desert kingdom with a population smaller than many megacities, yet a resource base powerful enough to tilt the global economy: Saudi Arabia. And here's what nobody tells you. This nation possesses something no other producer truly controls: spare capacity, the ability to flood the market on command. Here's why this matters. When Saudi Arabia opens its taps, oil prices don't just fall, they collapse. Competitors buckle. Governments strain. Entire sectors rewrite their forecasts. This is where the pattern begins, a recurring cycle spanning 4 decades, DARS, revealing how one state learned to use oversupply not as a mistake, but as a strategic weapon. The seeds of this power were planted long before the world realized what they meant. In 1980, global oil demand faltered after the shocks of the 1970s. Many producers, flush with petrodollars and new investments, expected high prices to last. At first, it looked like a miracle. Revenues soared, economies expanded, and ambitious development plans transformed skylines. Then the bill arrived. As demand weakened, non-OPEC producers like the North Sea and Alaska flooded the market with new supply. OPEC, divided internally, tried to defend high prices by cutting production. It didn't work. Other members cheated. Prices slipped. And Saudi Arabia found itself carrying the burden for an entire cartel. By 1986, the kingdom had reached a breaking point. Rather than continue sacrificing its own market share while others profited, Saudi Arabia executed a dramatic reversal. It opened the taps fully. Production surged. Prices collapsed by more than 60%. Here's what nobody tells you. This wasn't chaos. It was strategy. The kingdom understood that low-cost producers win price wars. High-cost producers lose them. The early 1980s oil crash devastated rivals, from Mexico to the Soviet Union. Everyone thought they were safe. They weren't. The danger wasn't what they saw. It was what they ignored. The fact that Saudi Arabia had demonstrated openly and decisively that it could reshape global prices any time its strategic interests demanded it. This moment formed the blueprint for everything that followed. Fast forward 3 decades. The world had changed. Shale technology had rewritten U.S. energy production. From 2010 to 2014, American output grew by millions of barrels per day. Analysts suggest that Saudi Arabia watched this rise with cautious calculation. Shale was flexible. Shale was fast. And shale threatened to erode the kingdom's long-term influence over global oil pricing. The world was entering a new supply era, one where U.S. producers could surge quickly, undermining OPEC strategies that relied on coordinated output reductions. By mid-2014, prices were slipping again. OPEC met in November to decide whether to cut production. Many expected Saudi Arabia to step in as it had for decades, reducing output to support higher prices. Instead, history repeated itself. The kingdom refused to cut, not retreat. Pressure. Saudi officials signaled that they would maintain high production to protect market share, even if prices crashed. The message was unmistakable. If U.S. shale wanted to compete, it would have to survive a price environment engineered by a producer with deeper reserves, lower costs, and far greater endurance. At first, it looked like a miracle for consumers. Gasoline prices fell. Industries cheered. Airlines and shipping companies enjoyed a sudden windfall. Then the bill arrived. The price collapse of 2014-2016 wiped out hundreds of American shale companies. Dozens of oil-producing nations suffered fiscal crises. Venezuela, Nigeria, Angola, and others experienced catastrophic revenue shortfalls. Billions in investment evaporated. The global energy sector entered one of its deepest downturns since the 1980s. Here's why this matters. Saudi Arabia had demonstrated a second time that the oil weapon was not a relic of the past. It was a living strategy, not political rhetoric, economic shock therapy, and the kingdom had become adept at deploying it. But there was something new this time, something that signaled the world was entering a more complex era. Unlike the 1980s, Saudi Arabia no longer controlled the global market alone. U.S. shale could rebound quickly. Financial markets had become hyper-reactive. And energy demand, though rising, was no longer a guaranteed upward trajectory. The early cracks in the old system were forming, and analysts argue that Saudi Arabia recognized this shift earlier than most nations dependent on oil revenue. Yet the full extent of the kingdom's power would not be tested until 2020. Before that moment arrived, subtle warning signs appeared. The global oil market grew oversupplied in 2018. Production surged in multiple regions. OPEC and Russia formed a new alliance, OPEC+, to manage output together, reflecting the reality that no single producer could stabilize prices alone. Saudi Arabia remained the core of this coalition, providing most of the cuts and holding the spare capacity needed to calm markets. But beneath the alliance, tensions simmered. Russia didn't want to cede too much influence. U.S. shale kept growing, and global demand, increasingly shaped by renewable energy growth and efficiency policies, no longer guaranteed comfortable margins. Everyone thought they were safe. They weren't. In early 2020, as a new virus spread across the world, demand collapsed at a historic pace. Airplanes grounded. Factories paused. Highways emptied. Oil consumption fell by nearly 20 million barrels per day, an unimaginable contraction. OPEC+ scrambled to negotiate cuts. But in March 2020, negotiations broke down. Saudi Arabia and Russia disagreed over how much each should reduce. And, once again, the kingdom reached for its historical weapon. Saudi Arabia launched a price war. It increased production at the exact moment demand imploded. The effect was instantaneous and devastating. Oil prices plunged to levels unseen in decades. Futures markets collapsed. Storage filled across the globe. And then the unprecedented happened. On April 20th, 2020, U.S. crude futures briefly went negative. Not low, below zero. Producers were paying traders to take oil they couldn't store. At first, this collapse looked like the end of the oil era. Then the bill arrived. The entire global energy industry reeled. Many shale companies filed for bankruptcy. Petrostates watched their budgets implode. And the world saw, once again, the pattern that had emerged across decades. When Saudi Arabia deploys its oil weapon, the consequences are not limited to rivals. They reshape the entire economic landscape. Here's what nobody tells you. This pattern is not accidental. It operates through a set of stages, a framework visible across the 1980s, 2014, and 2020 crashes. Stage 1. A perceived threat to long-term influence. New producers rise. Markets oversupply. Demand weakens. Stage 2. Saudi restraint fails to stabilize prices. Cuts by the kingdom no longer offset global shifts. Stage 3. The strategic pivot. Saudi Arabia abandons price defense and opens the taps. Stage 4. Market collapse and competitor attrition. High-cost producers suffer. Governments face fiscal distress. Stage 5. Recalibration and regained influence. Saudi Arabia reemerges as the indispensable stabilizer. This is where the pattern begins in its modern form, a cycle not driven by chance but by strategic necessity. And analysts suggest that today, the early signals of this cycle may be forming again. Demand growth is uncertain. Energy transition is accelerating. Rival suppliers, from U.S. shale to Brazil, Guyana, and Canada, continue expanding. And OPEC+ unity, while functional, is fragile. Which leads to the cliffhanger that shapes everything we explore next. If Saudi Arabia has crashed oil prices 3 times in the last 40 years to protect its power, what happens if it decides the world needs a fourth? When the price of oil collapses, most people see cheaper fuel, quieter highways, or headlines about turmoil in distant markets. But here's what nobody tells you. Beneath every major oil crash engineered by Saudi Arabia lies a deeper strategic calculation, one built on defending influence in a world that shifts faster than producers can adapt. The crashes of the 1980s, 2014, and 2020 were not random events. They were signals. And as global conditions evolve again, analysts suggest that Saudi Arabia may one day reach for the same weapon it has deployed across generations. This is where the pattern begins to reveal its modern shape. a kingdom navigating not only rivals, but an entire global system in transition. To understand where this cycle may lead, you first have to complete the story of 2014, a moment that reshaped the energy landscape more profoundly than many realized at the time. Saudi Arabia's refusal to cut production was not simply an attempt to suppress U.S. shale, it exposed the fragility of oil-dependent nations. Venezuela's economy spiraled. Russia entered recession. Nigeria and Angola faced budget crises. Even wealthy Gulf states dipped into reserves. Everyone thought they were safe. They weren't. And the danger wasn't what they saw on the surface, falling prices, but what they ignored beneath it, the fact that oil demand growth was no longer guaranteed. By 2016, OPEC Plus formed to stabilize markets. Saudi Arabia and Russia aligned as co-architects of a new price management system. Some economists argue this alliance was a recognition that neither nation could control global prices alone. Not dominance, collaboration. But the partnership was uneasy. Too many interests, too many pressures, too many unspoken rivalries. And then 2020 revealed how thin that alliance truly was. When the pandemic collapsed demand and negotiations broke down, Saudi Arabia deployed the most aggressive price offensive in modern history. They did not gradually increase output. They surged it, flooding a market already drowning in surplus. At first, it looked like a temporary quarrel. Then the bill arrived. Oil prices crashed to the lowest levels in decades, and for a brief, surreal moment, U.S. futures went negative. Tankers circled the seas with no place to unload. Storage facilities filled. Traders panicked. The entire global financial system felt the shock. Here's why this matters today. The 2020 crash didn't simply hurt rivals. It destabilized the kingdom itself. Saudi revenues plunged. Deficits widened. Vision 2030 reforms, designed to diversify the economy, faced new constraints. Some analysts argue that the kingdom learned a painful lesson. The oil weapon remains powerful, but not without cost. The world it operates within is no longer the world of 1986, or 2014, or even 2020. The energy landscape is more fragile, more interconnected, and more politically charged than at any point in modern history. So what comes next? To understand the future, you have to examine the pattern across all three historical crashes. Case number 1, 1980s, oversupply meets weakening demand. Saudi Arabia abandons price defense to break competitors. Result, global realignment, heavy casualties for high-cost producers. Case number 2, 2014, U.S. shale rises. Saudi Arabia prioritizes market share over price stability. Result, shale bankruptcies, fiscal crises across oil-dependent nations, new alliances. Case number 3, 2020, demand collapses. Saudi Arabia uses oversupply as a negotiation weapon amid unprecedented market chaos. Result, systemic shock, negative prices, fragile recovery. Look closely and the repetition becomes unmistakable. In each case, Saudi Arabia acts when its long-term influence is threatened, global demand weakens or becomes uncertain, rivals expand too quickly, price defense becomes too costly. A decisive shock can reset the system. This is where the pattern begins to converge with today's world, a world where demand forecasts fluctuate wildly, rivals expand aggressively, and energy transition introduces forces no producer can fully predict. Analysts suggest Saudi Arabia now faces a landscape defined by 5 conditional pressures. Pressure 1. The uncertain future of oil demand. Some scenarios indicate global demand may peak in the 2030s. Others argue new industrialization in Asia and Africa could sustain growth for decades. The kingdom must decide whether to defend high prices or accelerate production before long-term demand declines. Not certainty. Dilemma. Pressure. 2. Rapid expansion of rival producers. Brazil, Guyana, the U.S., and Canada continue increasing output. Each new barrel reduces the kingdom's strategic share. If this pattern applies broadly, Saudi Arabia may again consider overwhelming the market to reassert dominance. Pressure. 3. Fragile OPEC Plus unity. Russia's alignment is conditional, not guaranteed. Smaller producers resist deep cuts. In several scenarios, internal fractures could push Saudi Arabia to act alone, just as it has before. Pressure. 4. Energy transition and political pressure. Renewables rise. Electric vehicles multiply. Climate policies intensify. The kingdom cannot ignore these shifts. The question becomes whether to suppress prices to discourage alternatives or support prices to maximize revenue while demand still exists. Pressure. 5. Domestic transformation costs. Saudi Vision 2030 requires enormous capital. Analysts argue that a temporary price crash, strategically timed, could eliminate rivals and set the stage for a more profitable rebound. Not sabotage. Reset. Each pressure reflects the same historical rhythm, and this leads to the most unsettling question. Could Saudi Arabia crash oil prices again? Some economists argue yes, if the conditions mirror past cycles. Others suggest the kingdom's growing diversification goals make such a strategy too costly. Still, others propose a hybrid scenario where Saudi Arabia unleashes a controlled oversupply, not as a full-price war, but as a warning shot to rivals. Let me show you exactly how such scenarios might unfold. Scenario 1. The soft landing strategy. Saudi Arabia gradually increases production to signal its willingness to defend market share. Prices decline moderately. Rivals slow investment. The kingdom preserves influence without triggering global turmoil. This scenario minimizes risk, but may not eliminate competitive threats. Scenario 2. The forced reset. A geopolitical shock, demand dip, or internal OPEC Plus fracture pushes the kingdom to assert dominance decisively. Production surges. Prices drop sharply. High-cost producers retreat. The market resets around Saudi Arabia's terms. But the kingdom absorbs significant short-term losses. Scenario 3. The hard break. Multiple pressures converge. Declining demand expectations, rapid expansion of rivals, and weakened unity in OPEC+. Saudi Arabia unleashes a full-scale price offensive similar to 1986 or 2020. Oil collapses, economies wobble, governments scramble, and the kingdom reclaims the center of the global oil order at enormous cost to itself and others. At first, it would look like a bold assertion of strategy. Then the bill would arrive. The global economy, already sensitive to inflation cycles and energy volatility, could enter recession. Petrostates could face political instability. Investors could flee high-cost drilling regions. And the kingdom, even if victorious, would emerge into a world accelerating its transition away from fossil fuels. Here's the trap. The more Saudi Arabia uses its oil weapon, the more the world seeks alternatives. The kingdom cannot crush prices indefinitely without weakening the very market it depends on. And yet, it cannot ignore threats to its influence without risking long-term decline. This tension defines the era ahead. Here's what nobody tells you. The future of oil is not determined by geology or technology alone. It is determined by strategy, by leverage, by decisions made inside a royal court that has reshaped global markets more than once, and may do so again if pressured. But the deeper question is not whether Saudi Arabia can crash prices again. History shows it can. The real question is, what happens to a world in transition if the most powerful player in the oil market decides that the old cycle must repeat once more? One last reset before the age of energy dominance begins to fade? Because if the past 40 years have revealed anything, it is this. Saudi Arabia does not wait for threats to resolve on their own. It resolves them through shock, through strategy, through the oil weapon the world pretends it has forgotten. Not stability, leverage,